Now we'll talk about bond redemption, which is basically buying back the bonds from the bondholders. So a corporation may redeem or call bonds before they mature. This is often done when the market rate of interest declines below the contract rate of interest. And the company would do that because they're paying higher interest on the bond compared to the market. So to avoid that, they can call it back. But of course, they need to have this kind of feature that allows them to call it back, which are called callable bonds. So in such cases, the corporation may issue new bonds at a lower interest rate and use the proceeds to redeem the original bond issue. So what is callable bonds? Callable bonds can be redeemed by the issuing corporation within the period of time and at the price stated in the bond indenture or the bond agreement. Normally, and we should expect that, the call price is going to be higher or above the face value. So, of course, I'm not going to call the bonds from the bondholders at the face value. I have to pay them some kind of compensation so I can get it back from them. A corporation usually redeems its bonds at a price different from the carrying amount or the book value of the bond. A gain or loss may be realized on a bond redemption as follows. So a gain can be recorded if the price paid for the redemption is below the bond carrying amount or book value. So if I paid, let's say the carrying value of the bond is $1,050 and I only paid $1,030, so there's a gain. On the other side, a loss is recorded if the price paid for the redemption is above the carrying amount. So let's say the carrying value is $1,050 and I paid $1,100 or $1,100. So this extra $50 is a loss. So gains and losses on the redemption of bonds are reported in the other income or loss section of the income statement. So let's see an example. Assume that on June 30th, a corporation has the following bond issue. We have a face amount of bond that is $100,000 and we have a premium on the bond payable of $4,000. So this means that the carrying value or the book value of the bond is $104,000. So assume on June 30th, the corporation redeemed 1/4, which is $25,000 of these bonds in the market for $24,000. So as you can see that they paid $24,000 to acquire a $25,000 face value of the bond. So the journal entry would be as follows. We're going to credit first. I always like to start with the cash because it's something that we can all relate to. So we're going to credit the cash for the amount paid, which is $24,000. Then we need to cancel the bond, which is the $25,000. So to cancel the bond, remember, bonds are liabilities. They are usually on the credit. I'm canceling them, so I need to record the cancellation on the debit side. So the bond payable is going to be debited for $25,000. Then the bond has a related premium. And I just go back here. It was $100,000, and the $100,000 has a 4. So 25% of the 4 is $1,000 because we only redeemed 25% of the $100,000. So 25% of the premium is going to be $1,000, which is $1,000 out of the $4,000. So that's why we are redeeming or canceling the premium bonds payable for $1,000. So now on the debit side we have $26,000. On the credit side we have $24,000. So it's not balanced. To balance it, we're going to record on the credit side here $2,000, and that's going to be a gain on redemption of bond. And it makes sense because we acquired something that has a value of $26,000 and we only paid $24,000. So there's a $2,000 gain. So only the portion of the premium related to the redemption or the redeemed bonds, which is the $4,000 multiplied by 25%, is the equal $1,000, is written off. So this is the amount that we write off from the premium on the bonds payable. The difference between the carrying amount of the bonds redeemed, the $26,000, which is the 25 plus the 1,000, and the redeemed price, which is the $24,000, is recorded as a gain, which is equal to the $2,000. Now assume that the corporation calls the remaining $75,000 of outstanding bonds, which are held by a private investor, for $79,500 on July 1st. So we have something that has a book value of $75, and remember it has a related premium of $3,000, so the carrying amount would be $78, but we paid $79,500. In this case, there is a loss because we paid more than its book value. So again, we'll apply the same approach. I'm going to credit cash for the amount paid, which was $79,500. I'm going to debit the bonds payable for $75,000. I'm going to debit its related premium, which is the $3,000. So now we have $78,000 on the debit side, $79,500 on the credit side. To make it balance, I have to plug in $1,500, and we call that loss on redemption of bonds. So if the plug-in amount is on the credit, it's a gain on redemption. If the plug-in amount is on the debit, then it's a loss. So losses are always on the debit, like expenses. Gains are always on the credit, like revenues. Now let's cover reporting bonds payable and how they are reported on the financial statements. So bonds payable are reported as liabilities on the balance sheet. Any portion of the bonds that is due within 1 year is reported as a current liability. Any remaining bonds are reported as a long-term liability. So any unamortized premium is reported as an addition to the face amount of the bond. And any unamortized discount is reported as a deduction from the face amount of the bond. So I think that's just something that's easy to remember. Premiums are added, discounts are deducted or subtracted. The description of the bonds should also be reported either on the face of the financial statements or in the accompanying notes, or what we call the disclosures. So let's see how it looks here for our example. Morning Joe balance sheet for December 31st, 2016. You can see here we have the current liabilities, where we have accounts payable, notes payable, salaries and wages payable, payroll taxes payable, and interest payable. And then we have the total of the current liabilities for $131,400, which is the total of these values. And then under the long-term liabilities, we have the bonds payable for 8%, which is the interest that's paid for these bonds due in 10 years. And then we're subtracting the discount, and we always subtract the unamortized portion of the discount. So it's $500,000 minus $16,000, and that's going to be $484,000. The $484,000, this is what we call it the carrying value of the bond, or we simply can call it also the book value of the bond. And then we have notes payable, and we add all these together, and that would give us the total long-term liabilities. And then when we add all the three numbers together, then you get the total liabilities. Last thing in this chapter, we're just going to go for some analysis for decision making, and the ratio that we're going to be going over today is something called times interest earned. So analysts assess the risk that bondholders would not receive their interest payments by computing this ratio called the times interest earned ratio. And they do it during the year, and that's how it's calculated. So we have income before income tax plus interest expense divided by interest expense. So remember, we add the interest expense and then we divide the whole value with interest expense. This ratio computes the number of times interest payment could be paid out of the current period earnings. So basically, we're trying to figure out how much we can cover our interest expense using our income. So our income can cover how many times the interest expense. High values of this ratio are considered to be favorable, whereas low values are considered to be unfavorable. Values of this ratio less than 1 suggest that the firm is unable to cover interest payment from the current period income before tax. And I would say that would be a dangerous situation. So let's see a numeric example. The following data were taken from recent annual reports of 4 companies in the soft drink beverage industry. We have PepsiCo, we have Coca-Cola, we have Dr. Pepper Snapple, and we have Monster Beverage. So their interest expense are given to us here. You can see PepsiCo has the highest amount of interest expense. And then income before income tax expense. And you see that Coca-Cola and PepsiCo, they're somehow compatible. And then we have Dr. Pepper, much smaller, and then Monster is the smallest. So the times interest earned would be computed for these 4 companies. So we have the interest expense, we have the income before income tax expense. We're going to add them, and then we divide them by interest expense. So here we got the total, and then we divide it by the interest expense. You can see for PepsiCo it's 10.6 times. For Coca-Cola it's 20.3. For Dr. Pepper Snapple it's 10.8. For Monster it's 446. So of course you can tell that for Monster this is the best because they have very high time interest earned ratio. So if I'm a lender, I would feel very safe about Monster because they have like a high ratio. What comes next is Coca-Cola, and again I would feel very comfortable about Coca-Cola because they have like 20 times the ability to pay their interest expense. Of course, in this case, comparing the size of the company, I think for Coca-Cola this is a large company, it's a big name, so companies would be or lenders would be feeling okay lending these companies. And again, for the other companies, even like PepsiCo and Dr. Pepper, like having a ratio that's 10.6 or 10.8, this is considered to be a high ratio, which is also relatively safe. So by that, I just want to conclude this chapter. Wish you all the best of luck, and I'll see you in the next chapter.